On Thursday, we're going to meet in the normal classroom, and on that day, we're going to do something a little different called a concept inventory. And so a concept inventory is a brief quiz, although it's not going to be held against you in the same way that an ordinary quiz is. The way it's going to work is that if your performance on the concept inventory is higher than your quiz average, then I'll include it as another quiz to bring your average up. But if you do more poorly on the concept inventory than your current quiz average, then I'll ignore the score. So it's something that can only help you, it can't hurt you. And the purpose of it is twofold. Number one, it's a way for you to review some of the main concepts from the semester and see if you understand them or if you don't. And it can sort of get you in the mindset you need to begin preparing to study for the final exam. And then the other purpose of it is it's a good way for me to assess sort of where the class is at the end of the semester and which concepts have been learned well. So we'll do that on Thursday. It'll take the majority of our class time, although not all of it. So again, normal classroom for that one. Also on Thursday, the project is due, and your paper copy for that should be submitted in class. I won't accept late submissions, and so hopefully it's not the sort of thing where you wait until 8:55 to start printing it out. You should maybe print it out the night before you go to sleep, just to make sure that everything goes smoothly. Today we're going to be talking about depreciation, which is found in the textbook, and it's one of the important topics that are facing companies that are having to pay income taxes. And although we don't have taxes in the UAE quite yet, they've announced that a value-added tax is probably going to come in the next few years. And also, once a value-added tax comes, then there's others that are right around the corner. It's inevitable. So depreciation may become increasingly important. So on the picture here is a photo of two Hondas, an old Honda Civic from when Honda just first started making automobiles, and a newer model on the left. And the reason I show it is because it kind of represents what depreciation is. It's a decrease in the value of items over time. And they say that when you buy a new car, as soon as you drive it off of the dealer's lot, it instantly loses a lot of its value, just because now it's not a new vehicle, it's a used item. And depreciation is where we're keeping track of how much of that loss of value there is. Tax depreciation is a special subset of depreciation that is used as a deduction against income taxes. And so a company who is engaged in business for profit, the reduction in value of their equipment over time can be used as a way of reducing how much tax they pay. The initial cost of an item, we're going to assign that the variable B, which means the first cost or the cost basis. And it includes what you pay to get the item into service, not just the first cost of the item by itself, but also any taxes a company has to pay to purchase an item, as well as installation or even training for the workers to become acquainted with the equipment. The book value is at any given year how much that item is worth. And so the first cost is an initial value, and the book value is always going to be lower over time. Even though a handful of things get more valuable over time when you purchase them, those are the exception rather than the rule. And so the book value will always be declining based on how much depreciation there's been before it. Not all items can be depreciated. And so if we look at the categories of what can be considered depreciable and what isn't, for example, in order to take a deduction against taxes on a depreciation of equipment, that equipment has to be owned by a business to produce income. And so if you buy a car just to drive it around for your personal use, typically that's not something that you can reduce your taxes by owning your own personal items. Although a company that owns a vehicle, the reduction in value of that vehicle over time can be used by the company as a deduction for their income. Another thing that is required for an item to be depreciable is that its useful life has to be longer than a year. If it wears out very quickly, then that can't be considered because it's considered a non-durable good. The third criteria for depreciation is that it has to be something that wears out over time. And so things that never wear out, like maybe a gold bar or just something that would get locked in a vault and it doesn't actually decay over time, wouldn't be considered depreciable. Neither would the inventory that a company purchases and intends to sell. It has to be the equipment that the company is using in the course of their business. At the bottom of the screen here, I asked the question, why would a business want their equipment to depreciate? And so if you think about it, in reality, I'm not talking about in the view of the accountants, but in reality, what you want is your equipment to last as long as possible. You'd love to have your equipment be very durable and not wear out. But the accountants will tell you the opposite of that. The accountants will tell you that on paper, what you prefer is your equipment to wear out as quickly as possible so you have a really high depreciation in the present. So anybody want to guess why the accountants like to have depreciation and they like to have it as soon as possible? Less taxes, exactly. Remember, the whole point of tax depreciation is trying to reduce how much money you give to the government versus how much you can keep for yourself. And so present dollars are more valuable than future dollars. And money now is better than money in the future. So if you're going to get a deduction in taxes, it's better to have that deduction as early as possible. Any questions so far about depreciation? Mm-hmm.
How can you do it? Say that get money faster if the equipment goes out quickly.
Yeah. So how can you affect that?
Yeah, how do you do that?
Well, there's 3 methods for calculating depreciation. And in the third of those methods, it depends on what category the equipment is classified in. And so sometimes the accountants will try and play games with what category an equipment is put into because different categories depreciate at different speeds. And so what they'd try to do to play games is they'd say, well, this equipment goes in the category of items that depreciates really quickly, not the category that lasts a long time. So that's maybe one game that they'd play. Excuse me? Oh, now remember that there's a difference between the actual value and the book value of equipment. And so if you damage your equipment intentionally, that actually doesn't change the tax consequences of it. It's just the depreciation quantity and the book value is kept separate from the actual value of the equipment. So if it's in good condition or if it's in bad condition, that actually doesn't affect your tax deduction. Yeah. Yeah. Mm-mm. No, the insurance is just considered an expense. It's not considered part of the equipment itself. Yeah. There's 3 methods for calculating how much loss in value over time there is through depreciation. The first is called straight line, and it's the simplest of the methods because every year the amount of loss is the same. It's just a constant amount. That's the difference between the beginning value, the salvage value, and then you look at how many years it's in service, and you find an equal value. Rather than having a constant amount, in declining balance, you look at a constant fraction in deduction. And so let's say, for example, 20%. So what you'd say in declining balance is that every year the equipment is losing 20% of the previous year's value. And so it's a constant fractional loss rather than a constant amount. Now, the third method we'll look at is known as either the general depreciation system or by the abbreviation MACRS. And that is a method of depreciating equipment just by classification. And you don't actually do the calculations for that one. You just look up on a table what the depreciation amount should be. So it's the simplest of the 3 methods. But one unique thing about that method is that salvage value is ignored. All of the equipment is assumed to go to 0 value according to that method, even if you are going to have a salvage value of the equipment at the end of its useful life. Okay, so here's some terminology that you'll need to know in depreciation. A lot of these are the same as what we've been using before, such as the first cost and salvage value and so on. We've already talked about book value, and that is in a given year in the accounting books how much an item is worth. And it may not be the same as how much you could sell the item for out on the open market. It's just sort of, according to the accountants, as you're keeping track of the profits and losses, the assets are also calculated over time, and so it's the amount that the item is worth at a certain time. Personal property is kind of a strange term because you think personal property is owned by people, but actually companies are considered as people in a lot of tax jurisdictions, and the word corporation is actually, it means person or body. And so personal property are the items, the equipment items that's owned by a company, and that's what's depreciable. Real estate, for example, is another one of those kinds of items that isn't depreciable because it's not considered to wear out over time. Land. The value of land is durable rather than degraded over time. One last term that we're going to see when we do our third example today, the half-year convention. It's an assumption that's used that says you assume that everyone buys the equipment in the middle of the year. And so that in the third method, in the MACRS approach, you assume that if they're buying it in the middle of the year, you don't give them a full year of depreciation within year one. You split the first year's depreciation in year one and the last year. And so it's spreading out over calendar years, the depreciation amount.
Land doesn't lose value. What about like houses or any kind of building? It does wear out over time. Doesn't that make it too?
It does, but it wears out so slowly that usually buildings aren't considered as depreciable. I think temporary structures, like the trailers that are used at construction site, those can be depreciated, but a house or an office building, they have useful lives beyond 20 years, and usually 20 years is the longest that depreciation is taken out over. And part of the reason for that is, remember, the value of money in the future is so minuscule compared to now that even if they did let you depreciate over 100 years, the second half of that 100 years, the depreciation amount really wouldn't do you any good because future money is worth so little. Here's the formula for straight line depreciation. It's really simple. It's just the initial cost, the beginning cost, minus the salvage, divided by however many years it's depreciating over. And so that tells you how much the item loses in a given year. And so the book value in that given year T, it's a certain year, is the beginning cost minus the cumulative decreases up until that point. And so we'll see in this first example that we'll look at, if you have a piece of equipment that costs $20,000, and you know at the end of 5 years it has $5,000 in value, we're going to find out how much depreciation is there in year 3, the book value in year 3, and then a graph of book value versus time. And so it's relatively straightforward. You just have the first cost minus the salvage value divided by the total number of years that it's depreciating. So that means every year it's going to be the same $3,000 of depreciation. And so that the book value in year 3 is the initial cost of $20,000 minus 3 years of $3,000 per year. So $11,000 is just how much that item is worth at the end of the 3rd year. And you can see it's called straight line depreciation for a reason, because the value over time decreases linearly. And so there's the graph of the book value versus time. Any questions about straight line depreciation? Declining balance is a little bit more complicated, but it's still not too bad. Remember, instead of declining by a fixed amount, it's declining by a fixed percentage. And there's a couple of rules about how this works. Sometimes that fixed percentage is stated directly, and sometimes you have to calculate an implied fraction based on a given salvage value. I'll show you the formulas for each. One of the rules is that the depreciation rate can't be any more than double the straight line depreciation rate. And also, there's no such thing as depreciation so much that the overall value goes lower than the final salvage value. So here is the formula for how you calculate the depreciation in a given year, T. And so it's the depreciation fraction minus the book value of the previous year. And so when we do this on a spreadsheet, we'll be looking at the book value in the row above it in order to calculate the depreciation for the row that we're on. So T minus 1, the interpretation of that is just previous year, than the year that you're on. Now here are the two ways to calculate the depreciation fraction. One is if you're told a percentage, and in today's in-class exercise, for example, the problem we're working is 150%. And so if you're given a percentage, you turn that into a fraction according to this method where n, down here in the denominator, this n is the total number of years. The alternate approach is if you're given a salvage value, then you calculate the implied depreciation based on the known first cost and the known salvage value. And then again here, n is the total number of years. So you use these two approaches to calculate D, which is the fraction of depreciation. And so that if you know the depreciation for each year, you can calculate the book value that way. Or you can calculate the book value by this formula, where it's the starting value multiplied by some reduction fraction, where here T is the year that you're on. So let me show you an illustration of that. Let's say that we buy some equipment that has a first cost of $80,000. It's going to last for 10 years. And there's two ways we can depreciate that. We can either depreciate it according to 150%, where we're given the percentage and calculate the fraction from that. Or in part B, we'll calculate it with a known salvage value. So let me show you that illustration here. Okay, in part A, we're starting with the percentage. We have 150%, it's 10 years, and the first cost is $80,000. So the first step that we'll do is we'll calculate D with this formula, and that gives us a D of 0.15 because it's 150 divided by 100, so that's 1.5, and then N is 10. So that's where 0.15 comes from. It's talking about the rate of loss, and since this declining balance switches between a straight line method and it sort of tapers so that you're never getting to zero, it looks like this. And so 150% is just a way of saying how steep the line is. If it was 200%, that means you're losing the value more quickly. It's a rate of loss. So here, this fraction is the amount that we're losing each year. So 80,000 is the starting book value. 12,000 is 15% of this amount. And so the book value at the end of the first year is just the previous book value minus the depreciation for that year. The same thing is true for year 2. For year 2, we look at the previous book value, multiply it by the fraction, and that's where 10,200 comes from. And then the book value is the previous book value minus the depreciation for that year. A similar approach is used in part B. In part B, it's saying, what if we have a known salvage value of 10,000? So for this one, we have to calculate the implied depreciation fraction with this formula. And so S is 10,000, B is 80,000, and N is 10. So it's that formula that leads to D being 0.1877. And then it's the same approach from here. We start off with a known first cost of $80,000, and so that the depreciation amount is going to be the fraction multiplied by the previous book value, and then the book value for this row is the previous book value minus the depreciation amount. And it goes all the way. We should see that the quantity of the book value terminates at 10,000, which is the given salvage value at the end. So that's declining balance. The third approach, this MACRS, it always depreciates to 0. There's no salvage left over. And so from an accounting perspective, that's good because you get a larger reduction in your income taxes if you're paying them. But the recovery periods are standardized based on the classification of the equipment. And let me show you what a table of that classification looks like. If you buy equipment that's related to telephone central office equipment, so like the equipment that Etisalat's buying to route cell phone calls, so that equipment would have an assumed useful life of 10 years, according to this system. Equipment that's related to the manufacture of cement, you'll notice that has an assumed life of 15 years. And the column that we're going to use is the GDS column. On the other hand, there's equipment like automobiles, buses, taxis, that sort of stuff. It depreciates a lot more quickly. It's assumed to depreciate over 5 years. So once you figure out where your equipment falls in this table and how long it's going to last, you go to the next table and you find the column that corresponds to your equipment. So if it was the telephone equipment, 10 years, you're using this column. And these fractions here are telling you the fraction of the initial value that gets deducted each year. That's a little bit strange. What do you notice about how many rows there are for the 10-year depreciation category? There's 11 years. Anybody want to guess why there's always one more year than it's saying? So the 15-year has 16. If you look at the 5-year, it actually goes through 6 rows. It's not related to that, although that's a good guess. It ties back to what we talked about earlier. There's the half-year assumption. And what they assume is that you're buying it in the middle of the year. Not that you're buying it at the beginning or at the end. It's always assumed that you buy equipment in the middle of the year. And so you'll notice, look at the first year of depreciation. It's less than the second year. So they only give you a partial credit for the first year, and then what they do is they move the rest of that value down the line so that you get half credit in the final year as well. So it's just an assumption related to how long and when the equipment is owned. It's spread out over, for example, 11 calendar years, but since you buy it in the middle of the year, the equipment itself only lasts 10 years, since you're getting a half year at the beginning and a half year at the end. Yes? Mm-hmm. It's less in the first year because they assume that you buy it in the middle of the year, and so they only give you half a deduction in the first year because in their assumption, you bought it partway through the year, not at the beginning of the year. So they don't want to give you full credit if you only owned the equipment for part of the time. Mm-hmm.
Is it better from an accounting point of view that you buy all these equipment at the beginning of the year?
No, the best thing to do if you really want to work the system, you buy all your equipment on December 31st. Because then you still get a half year's deduction, but you only owned it for 1 day at the end of the year. And for the same reason, in the United States, you get a deduction for having children on your taxes. They say it's like, oh, it's a fun thing to have your baby on the 1st of January, right? But it's better from a tax perspective to have your baby on the 31st of December because then you get a whole year's deduction, but you only have to have the baby for 1 day, right? So it's better to get the deduction, have it early. All right. The last thing I want to show you before we move on to the in-class exercise is how you apply those fractional deductions that we look up on the table. So in the table, those are lowercase d's. That is the deduction fraction for a given year. You multiply that by the first cost of the item, and that tells you the deduction for that year. And the book value is just the sum of all the previous deductions taken away from the initial starting book value. All right, so in today's in-class exercise, does everyone have that paper? What we are going to be looking at is trying to do the straight line, the declining balance, and if we have the time, on part 3 on the back side of the paper, try the MACRS method. In the straight line, we've got 3 different pieces of equipment, and they last 3 different amounts of time. And so I'll show you the format of the spreadsheet that I used. You can use any approach you prefer, but this is what my table looked like. I had each equipment separate, and then in the end, I calculated a total. And so there's a depreciation column and a book value column for each of the equipment items. So that's what we're going to do for the in-class exercise.
So is it going to be a conceptual class?
Yeah.
Like short answers or?
You'll see. You'll see. It's a little bit different. I don't want to give too much away, but
Okay.
yeah.